presentation, this webinar, Julien will have the pleasure to show you some facilities, new functionalities of the Quantalys Global series. I don't know, Julien, if you want to start, probably two information. The first is we will record this presentation, and you will have the pleasure to have access to the replay on our website and see this video on a regularly basis if you want. And the last point is the Q&A. You will have the ability to raise questions via the chatter box, or through the GoToWebinar in the GoToWebinar, or directly via email if you want, and we'll get back to you. I don't know if you want to start.
Just wanted to say that everybody can ask questions, and the question will be answered by the end. So you already said it. So if you agree, we can start the presentation.
Yes, let's begin. And the first point in introduction, we can probably, Julien, give a quick update on Quantalys. Okay. So I will explain the plan and the summary. So next slide, you have the executive summary. So the introduction, some update on Quantalys. Then we'll talk about the market condition, in fact, for the flexible funds. The point number 3 is a presentation of this category, the part of the European fund industry, and some key figures on this category to better understand, in fact, the trend and the importance of the situation today for the European fund industry. Flexible fund, considering the number of flexible funds distributed in Europe, it will be important to analyze this category by clustering. And when we say by clustering, we'll explain how we analyze, and we analyze via fund profiling and analytics. And we'll finish by 2 important slots. The first is fund flows, and the key trends of the industry today. And the last is Q&A, but mainly Quantalys Global. So Julien, you will show some functionalities dedicated to the flexible funds. So next slide, we'll talk very briefly on Quantalys. You probably know, you all know Quantalys now. You know that we are a European player. We have 3 capabilities. The first 3 main capabilities is the fund data. The second capability is digital solutions. And the last one is research, fund research, and fund ratings. Next slide, the update also is about Harvest, because we merge Harvest, Fidroit, Quantalys in a group. And now we are playing together, one team. The key figures are really impressive now. We are certainly one of the biggest wealth tech company in France, and certainly also in Europe. 411 employees working together, which is impressive. Nice growth of 34% in terms of growth of the revenue in the last 12 months, and a nice market share also concerning the wealth management industry. Clearly a very important player now in different countries, France also, of course, Italy, but also, as you know, Switzerland, Belgium, Luxembourg, and other countries, Monaco, and so on. We'll dive in details and start the presentation. So next slide on the flexible funds. The idea with these 3-4 slides, next slides, will be to talk about these, what we call new paradigm. I mean, these new market condition we could be perceived as perfect conditions for the flexible fund managers, and we'll see in details what is it about. So next slide. Probably the new paradigm. So just to illustrate this new trend, the fact that central banks are diminishing their balance sheet. On the left, you can see the increase of the balance sheet globally in the world, in percentage of the GDP, but also in the global debt in trillion. And on the right, you have the balance sheet of the central banks. It's roughly, you have to have in mind the balance sheet double in the last 2 years, because in end of 2019 it was 15 trillion, and now we are close to 30 trillion. So the double of the balance sheet, and clearly the situation, the policy now is to trying to diminish this balance sheet and this massive injection dose of liquidity in the market. It means a repricing, and we already saw that on the fixed income market and equity market, and also market volatility, of course. So after 3 decades of injection of liquidity, the market is considering these new calibration of these main actors, governments and central banks. Next slide. Another impact and consequences and illustration of this new paradigm is interest rates. As you can see, after 3 decades of decrease, we have this new rise, and it's now reversing because of the central banks. They are tightening their policy, but also the inflation surge increase. And so it's clearly relative, because we are still in negative level on the ECB, the deposit rate. But you see the situation on the 10 years or long-term interest rates, and this high increase in Europe, in the US. So in the US, it's roughly double, in fact, since the beginning of 2020. It was 1.5, it's today close to 3%. And so the impact, it's really massive on the market effect and the situation in terms of diversification for the portfolios. Next slide. Another important point, of course, is illustration. So we have the stagflation question about the growth, economic growth globally. So we anticipate the diminution by 2, 6% growth. Now we are talking about 3% growth for 2022, which is still growth. It's not recession, but the move is clearly important. And on the other hand, we have the symmetric move on the inflation, but it's close to 6% in Eurozone. So in the Eurozone, it was 3% last year and in the beginning of this year, and now we are talking about 6% and more in Europe. And it's clearly a big chunk for all the industry. We now consider that the whatever it takes, the whatever is inflation now. We understand that. And the bad things are also from the ECB and the central banks communication is that the inflation will be certainly sustainable. It's not just a tactical effect because of the energy, but it's more sustainable. That's what we show. Next slide. On next slide, you have these figures on the unemployment. You see the unemployment rate in Germany, it's 2.9%. In the US, we are breaking the records low. And considering that in one hand it will be more sustainable, in the other hand all the mega trends we are considering, we considered on the last years, climate change, onshoring, social changes because of the COVID, the remote, onshoring and deglobalization, I would say, of the economy, will be source of inflation in a way or another. So that's the message of the central banks and the government now. Next slide. As you can see, so the impact on the market is huge. It's again unique situation for investors on the last 30 years, on the last 3 decades. We never see this kind of situation. On the slide, on the graph, you have the performance, annual performance on equity in red, and the annual return of the fixed income, the Eurozone bond category in blue. And as you can see, year after year, even if you have a equity crash, so a crash on the stock market, like in 2008, you have a nice return on the fixed income and the bond category. And so this diversification means something. You have, I would say, with Hans, the ability to understand this diversification, this risk parity, and the uncorrelation between the fixed income and the equity sometimes to protect your diversified allocation portfolio, which is not the case today because of the negative return in the bond categories, at the same time with the negative return on the equity categories. And so you understand perfectly that the allocation, the diversification with equity plus bond is over. The buy and hold strategy is over, really difficult. And now you have to find source of diversification, source of return, and to be certainly more tactical. And so it's, in one hand, certainly positive for the flexible fund and the fund manager with strong conviction, and we are able to see this rotation. On the other hand, if you have false, not true flexible, and you are just buy and hold strategy, you will see this nightmare and this difficult situation for your your return. So next slide, we try to understand, we will see, in fact, illustrate this situation and this huge dispersion among the flexible fund in terms of return. And as you can see, in 2022, so just on the first 4 or 5 months, if you would say end of May, because it was the 14th of May this year, you have the worst flexible funds deliver 40% negative, and on the other hand, the positive, the best funds deliver 12%, and we just listed, communicate some name of the big blockbusters like Refer, positive 5%, or DWS, or Deutsche Bank, Calden Morgan, negative just 1%. You have the performance of the category minus 9%, and you see this dispersion, very difficult situation. Certainly the most aggressive and correlated with the markets, so bond market or equity market, never mind, are delivering close to 20% negative return, and on the other hand, flexible funds who are still positive and who benefit from this situation. So next slide, we try to understand why some fund managers are positive. It will be not this part, in this part, but in the next part. But before that, we'll try to give you some key figures concerning the industry in Europe and the positioning of the flexible funds in this industry. And you will see the importance of these funds. Globally, flexible funds are representing 50% of the allocation funds of these categories, very important. They manage 1.3 trillion euros end of April. So it's not bad. It's 15% of the industry globally in Europe, and as you can see, very resilient and very stable in terms of net inflows, because in April or year to date in 2022, the flows are still positive, which is not the case for the industry globally, because on the left in the graph, in the chart, you have the asset under management of the European industry, 10 trillion end of last year, 2021. And you have extreme right, the asset under management at the end of April 2022. And you see this big impact first on the market. So the market effect is explained a decrease of 614 billion euro in terms of decrease. But you have also net outflows of 120 billions for the industry, coming from the bond market and money market. As you can see, we have two positive net inflows in the industry in Europe. The first is equity funds, so very resilient, very stable. Investors are still zen, considering the condition, the market condition we just explained, and considering Ukrainian war, etc., etc. But investors are still investing in equity funds. And on the other hand, you have also allocation funds and flexible funds are still attracting net new money this year, which is very important to understand. So having these key figures in mind, we can dive in details and give you some trends very rapidly. I don't want to dive in details and explain every figures, but just to explain that flexible funds are close to 12–15% of the industry in Europe, and you have the trend of the last years. Next slide, you have the asset under management, so close to 700 billion euro for the flexible funds, 8% of the industry in terms of asset flows. If you aggregate the assets of the allocation funds, you will get 16–17% of the industry in Europe in terms of assets under management. Next slide, concerning the flexible fund, you have the global flexible fund investing globally, and the rest of the world, the rest of the universe, 64% global flexible fund, and the rest, so one third in investing in other, so European reach, etc. But the big chunk is the global reach, the global flexible fund category. Next slide. Always to understand the challenges, you have the net inflows, and you can see the market effect we detect at Quantalys. We split market effect in blue and in gray the inflows, the net inflows effect, I would say, still positive in 2022, as I said before. Next slide, the ESG, very small impact on the flexible fund, because as you can see, flexible by definition means you jump in equity, bond, credit, etc. And so the integration of the ESG criteria is much more difficult, but it's just the beginning. We see these emerging, this rise, and it's still very important to track and to follow for the next months, because ESG is a very hot topic today. Next slide. We wanted to highlight the fact that in flexible funds, you have tons of small flexible funds with the fund size below 100 million euros, so very small flexible funds. So in terms of distribution, very difficult to distribute. You have also these 500 or 600 flexible fund with a reasonable decent size of 500 million euro. And you have the blockbusters, 250 blockbusters managing more than 500 million euro. And again, as you can see, the last part, the big, the giant, the mega flexible funds managing more than 5 billion. And honestly, we'll dive in details and give you some analysis after. But when you want to be flexible, it's difficult at the same time to manage 20, 25, or 30 billion. You understand very well that it's difficult to be flexible and to be mega, to be big and large. And we'll give you some example with Julien after. Next slide. We wanted to explain the market share and the split of the industry and the fund promoter in terms of asset under management. And as you can see, you have both small independent boutiques like Flossbar in Germany. In France, we know Carmignac and so on. So Belgium, Lux, German, French boutiques who have this expertise allocation in their DNA. And you have also a very important part of the market share managed by the big, the major distribution channels. You will see names like Allianz, Amundi Crédit Agricole, Horizon in Germany, BNP, KBC in Belgium, UBS in Switzerland. So these players, these actors are providing in their channels network a large number of flexible funds or allocation funds. It's a big part of their business and competing against the, what I could say, the specialists, so M&G, Carmignac, Flossbar, and so on. The next slide is an illustration just to highlight the importance of the site. I mentioned the difficulty, it's always difficult to manage and to be flexible when you are large, but it's easier to collect and to aggregate new money when you are large. And as you can see, you see a strong, high correlation between the net inflows and the attraction in 2021 and the size, the fund size of these blockbusters. It's easier for Allianz to attract 5 billion when your fund, Allianz Allocate in Income and Growth, are managing 33 billions. Flossbar, the same, 25 billions. They attract 3 or 4 billions last year on their blockbuster, etc., etc. So you have, in fact, two different match game in the game. You have the big blockbusters who attract large amount billions. The winners take all, and you have also the small flexible fund. And the game in that case with Quantalys tools is to detect these newcomers. In fact, you have these blockbusters, not really agile, not really flexible always, but with nice market share. And you have the newcomers, and the game is to detect these new players who are certainly more flexible in this new context, new environment. How to do that? We'll see. So next slide. we just finished the presentation of the category, explaining the importance in France and in Luxembourg of the life insurance contracts and the fact that your funds are listed as unit-linked in these wrappers. And so you have some figures and you have the ability to find this information in Quantalys tools. I don't want to waste, to spend too much time on this slide. Next slide is also to explain that at Quantalys and Harvest, Fidora Quantalys, we have the ability to aggregate the assets managed and advise by the advisors, IFAs and FAs, and you see that these advisors are consuming a lot of flexible funds when they're in their recommendations. As you can see, it's sometimes on average 18% of their allocation portfolios made by flexible funds, which is really important. Next slide. The net inflows. As you can see, a nice resilience, nice situation for the flexible funds in 2022, even if the market conditions are very difficult. You see these positive net inflows even in 2022. And we consider that the trend will continue. Why? Two major points to understand this trend in 2022. Next slide, we wanted to explain why this trend to continue. First, given the high level of cash among the retail investors all over Europe, so the European playing field in France, you have the figures in France, but also in Germany, everywhere in Europe, in Italy, investors are defensive and the cash deposit or the assets in the wrappers are more and more important and are massive. The second reason on the next slide is the jump in trading and neo brokers. So in one hand, you have this barbellization, very important saving assets in saving, very cautious cash deposit. And on the other hand, because of the inflation, given the negative real return on interest rates, you have these, I would say, new traders who try to capture returns and performance with Bitcoin or with derivatives or with ETF in lithium, uranium, on copper, crazy investors who want to trade the market. And we understand, we know as professional, it's just impossible to trade. It's not so easy. And so this paradox, this, I would say, French paradox, this situation, this barbellization, in fact, investors understand very well, because between savings and trading, you have a way which is investing, and you have to outsource the management to to managers via flexible fund, for example, because the context is certainly more favorable for the conviction fund managers and not index passive funds. So next slide. We will try to analyze and clusters and profile these flexible funds, because you have flexible funds, and flexible funds, you have so many styles. It's important to use Quantalys tools to better understand and analyze this universe before selecting. So next slide. We try first why to use Quantalys tools and to cluster this universe. First, because you have 2,289 different funds. Clearly, quantitative analysis will help you to analyze this universe. You have the risk return analysis with each point, in fact, is a fund. And with Quantalys, you are able first to monitor and to calculate on average the return this year. So on the left, you have -9%, as you can see now. And the volatility, the standard deviation on average of the category is 7%. And you can see this dispersion. In blue, you have low volatility fund with close to positive return, but very few funds. More important are the funds who are in this bucket, yellow bucket. And you have also, in terms of volatility, flexible funds who deliver 20, 25, 30, 40% volatility standard deviation this year. So clearly, we are not boxing in the same category. On the right, you have the same analysis on the last 5 years with annual return of 2% on average for the category with the same level of volatility. And you have the similar situation, defensive flexible funds in blue. In yellow, you have the flexible funds which are close to the category in terms of risk return. And on the red, you have flexible funds who are doing something, I don't know what, but they are doing something with high volatility, 20, 25, 30% of volatility for this fund. So clearly, you have to cluster and to analyze eggs with eggs and to better understand and to better compare in peer group. The next slide, we try to analyze with similar situation with the fund profiling. The fund profiling on the left is the ability to analyze the up capture on the last 3 years and the down capture. Up capture means the percentage of the return captured by the flexible fund when the markets are up, are increasing. And the down capture is when the markets are decreasing. And so you understand very well that the best is to have a positive skewness and asymmetry when you select a fund. You clearly prefer to select a flexible fund who capture 150% of the increase, and on the other hand, who capture just 50% of the decrease when the market decreases. This is clearly the dream. You know, you have this positive asymmetry. You capture more when the market is up, and you capture less when the market is down. And it gives you this graph. Clearly, on average, you have these 64, 40, 44, so 64, 74, sorry, and you have the asymmetry, the neutral asymmetry close to 1:1. In fact, you capture 100% and of the up and of the down, you know. But this graph clearly show you that in red you have negative skewness for the worst flexible funds, certainly too aggressive capture too much down, and a lot of positive also. Very interesting to see in blue the flexible funds who are able to be more positive and positive asymmetry when the market is up and less when the market is down. But another way to split this universe. And on the right, you have the annual return on the last 3 years. In that graph, it's 3 years, not 5 years like previously. And you have the beta, equity beta. So we are able to measure the beta, the equity beta of the flexible fund of this universe with regression, regression with the equity beta indices. And you see, in fact, that this aggressiveness, this level of aggressivity is due to the equity beta in the market, because on the last 3 years, the scenario of the portfolio manager was TINA. There is no alternative. You have to invest in equity because of the level of interest rate. And we see that on this graph, a lot of flexible funds who are always who has always high correlation with the equity market. Some of them are more mixed and balanced, moderate in yellow, and others are more defensive and generate positive return, even if the equity beta, the equity markets are negative. So a good way to simplify your analysis with Quantalys tools. Next slide. So to conclude, in conclusion, we have, of course, in Quantalys tools, the ability, we already pre-calculate this kind of analysis to save time, of course, and you have not to export all the data and to analyze this on Excel, we already pre-calculate quantitatively these metrics. So the Quantalys barometer is in fact a good way to profile the fund and to have the up capture, down capture. If the market is more positive, capture is positive when the market, equity market is up, and on the contrary, it's more positive when the market is down. So you have on the left flexible funds who are delivering nice return when the market is down and more defensive. You can see Julien show you the 5 blocks when the market are negative. So strong resilience and good performance relatively compared to the market. I give you some examples. Refer International still positive year to date, or Sunny Patrimoine 2.0 in France still positive, deliver 8% year to date in this flexible fund universe. In the middle, you have yellow, close to the category. As you can see in the barometer, positive in each situation when the market is up, neutral or down. So you have a good mix of 4-wheel funds, stable in each situation. A nice benchmark of this category. I give you some example, Odo Polaris or Flossbar in Germany. And on the right, you have in red the return enhancer, what we call return enhancer, more aggressive, of course, you understand, with a high correlation with equity beta, equity market, like First Eagle, Amundi, or Erco for Rothschild. The next slide is the ability to first fund screener and select your funds and compare your fund, and also to select with this barometer what we call behavior and ranking, and you have the ability to select your flexible funds, but flexible funds, that's the topic of the day, with these metrics and ratio. Julien will show you in 2 minutes an example with Quantalys Global. I want to finish this presentation with the fund flows, and then I will leave the floor to Julien. The last figures is considering the net inflows. Very difficult situation for the industry in 2022 because net outflows are above 120 billion end of April. So it's not a good vintage for the fund industry in Europe. But as you can see, we are positive in equity. So the equity funds are still attracting new money and net inflows, but outflows are coming from bond, fixed income products, and money market. Give you some details. Next slide. First, the outflows from the bond market are accelerating today, as you can see. So in 2022, and the equity funds are relatively zen and relaxed. Investors are not stressed by the equity market at this stage. We have not this sell-off effect now in equity. It's not perfect, it's not positive, it's not a wow year vintage, but the investors are still are staying zen during these first months of 2022, relatively to bond especially. Next slide, you will see the flows. So we split the equity inflows between active and passive, and you can see that last year it was clearly active year for the active fund managers. This year is more a mixed situation, bittersweet, because you have a relatively nice situation for the ETF. Investors are using ETF in this situation, and it's more bittersweet for the active fund manager. It depends on the categories, of course, as you know, and the same mixed flavor, I will say, for the ESG. Very strong last year, 66% of the net inflows in ESG. This year it's more difficult, especially with Ukraine. On the short term, we are talking about commodities, natural resources, energy, oil, army, defense, security, etc. It's not necessarily ESG thematics, of course, as you know. And strong year, very good year for the hedge funds. We are breaking records for hedge fund and absolute return category. Next slide. Flexible. Global and thematics, but flexible. To finish my presentation on flexible, a good year relatively in 2022 relative to this maelstrom and turmoil on the market, because as I said, investors want to stay invested, and very difficult for them to time the market, to build asset allocation, and they prefer to outsource this selection and this timing to flexible funds. So sorry, we made a mistake. The title is not evolution, so net inflows for equity funds, but net inflows for flexible funds, and we will and allocation funds. We will change the title and send you the right presentation. That's all for me, folks. I don't know if Julien, you have still some slides, but I think it's the last slide.
That was this one.
Okay, this one concerning the top best promoters in terms of inflows, because I said inflows are still positive for flexible. If you track the net inflows year to date, you have names like Varenne Valeur in France, Flossbar, BlackRock Global Allocation, Acatis, and so on. So you have boutiques and distribution channels, and but the blockbusters are still collecting during this environment.
Sorry.
To illustrate the ability to analyze the fund flow, flexible flows in Quantalys tools, I will leave the floor to Julien to show you how to first use fund screener in Quantalys Global, then fund compare, how to compare the funds, and to dive in details with the analysis correlation barometer. And at the end, we'll show you the what if scenario, how to backtest a model portfolio.
Exactly. Thank you so much, Jean-François. You must be thirsty. So let's go to the practical how to get the same information for you. So as you have understood, Quantalys gives you access to licenses, and the one that we are showing you is the global one, giving you the possibility to request through 120,000 funds available in all these countries: Austria, Belgium, France, Germany, Italy, Luxembourg, Portugal, Spain, and Switzerland. And to come back to what Jean-François said, let's make an example and have a search using our search engine, and using our category. Let's focus on flexible allocation, and let's make a search for only global allocation. This will bring us a first result, and while it's making its search, I want to show you that
you have 4,000 different funds, just for your information.
Yes, exactly, 4,300.
Yes.
And you can use more than 80 filters to filter through these funds. So I'm going to shorten the search using the currency and focusing on euro funds. and main share classes. So if I make a new search, I will go from 4,300 to much less. I don't remember. It's close to 2,000
Okay.
funds.
You eliminated flexible funds in US dollar or Swiss franc or sterling, etc., etc. So you will certainly have less than 2,000 flexible funds, which is
1,500.
1,500. Okay.
Okay, so first of all, as you can see here, you have several information available, like ratio on a 1 year, 3 year, or 5 year basis. But also here, you can see the net fund flows. So if I click here and I double click here, I can go in a descending order and finding the funds that
You
have
will
the
find
high.
again my blockbusters. Your idea is to
Exactly.
find these famous blockbusters.
Exactly. So, unfortunately, it will be very similar to what Jean-François just showed you.
Cross my fingers. I hope we'll see these names, Flossbar and BlackRock.
Exactly. So here they are. So
Okay.
let's pick the three first one in terms of volume, and I have already opened an example with Flossbar. So.
Okay.
Here is an example of our very famous fund
Shit.
sheets. First of all, you can see 3-year performance of this fund compared to its category and its index. Here are all the information of the performance. And as Jean-François showed you earlier, we have here the barometer, and it's very easy to understand. The more blue blocks you have, the best the fund behaves in a
We
bullish
understand.
or
We understand with this fund profiling. That's a very good flexible fund in all situations. The up capture and down capture. So globally, on average, very good. And on the right, you have the quartile. As you can see, the fund is first quartile and short term and long term because on the last 10 years. So clearly, the blockbusters who represent the most, who represent this category. And you have the graph, the average, the category, and the index. And as you can see, Flossbar is clearly on the average, a little bit above, but clearly in this funnel, and very interesting to see the blockbusters. And it's important. It gives you an idea why it's so stable, because Flossbar is managing 25 billions, and when you manage 25 billions, it's not a small boat. It's clearly a big, large boat. It's difficult to be flexible, so they prefer to it. You have to expect from this fund to be in the category and not generate extra alpha in up or down capture. So to give you really the benchmark of this category of the industry.
yes, and also if I click on this matrix, you can see. So the blue point is the fund that we are looking at, and it's really in the middle of the mark of its category, and it really corresponds to what Jean-François just said. So again, all this information is available on the Quantalys. You can have it, you can print it in PDF, you can export it in Excel. So here is for the example of a fund sheet. Let's come back to our result, and let's say that we want to compare, we want to have a view on the three first blockbusters. So I just have to select them and click on compare. This will lead us to a graph showing us a 3-year performance. And as we prepared this presentation, we agreed on the fact that we are going to show you that we can add the categories, and let's put the category for bond global, and I'm going to add also equity global. And this gives you like I would say a way to understand how these funds are built, meaning that if they are close to this red line, they are close to the performance of bonds. So you can elaborate the fact that they are mainly built on bonds, and on the other hand, the equity category shows you let you guess. I mean, I would say the composition of the BlackRock global allocation.
Could you share the correlation between these different funds?
Exactly.
and probably concerning the period, if you can increase the period and compare this fund not just on 3 years but on the
Exactly. So
maximum.
that's a very interesting possibility in Quantalys. You just have to select common track record, and it will instantly find the common period for all the one that you wanted to list. So we are quite lucky because
the correlation, it will be interesting to see the correlation of these. If your screen could be larger, it would be great because it's a little bit small.
Oops, I am so sorry. I've closed my. Please accept my apologies. I've made quite a mistake. I have to do it again very fast. So using our comparison, you can really focus on the details that you want, and you can even personalize the information that you want to stress.
Okay. So Julien, we talk about fund screener, fund fact sheet, and how to analyze the fund profiling of each fund. We saw how to compare to the fund compare. We can probably jump in the portfolio model, so the backtest, how to backtest the portfolio, yes, a portfolio of flexible funds, and how to to analyze and producing what I'd say model portfolio or what if scenario in order to illustrate the power of Quantalys tools in this kind of portfolio analysis. So it's not fund level, but it's on the portfolio at a portfolio level.
Exactly. So what we did to prepare this presentation is to build a few portfolios. We have selected the top 10 flexible allocation and made a portfolio made of equal parts of all these 10 funds. And as you will see here, you can
find again these blockbusters. So I see Carmignac and MNG and Chiquier, DNCA, and so on.
Exactly.
Okay.
And as you can see here, you have a clear vision of the role of each funds within this portfolio. So
okay.
Here, go on, Jean-François.
Sorry.
You wanted to say something?
No.
Okay. As you can see here, you have the performance here, volatility, and it can help you identify maybe the one fund for which you want to maybe have a focus and consider maybe changing this fund. And very easily, you can see here that this fund is highly volatile if you compare it to its performance.
Considering the level of the return is clearly on the right, so it's clearly delivering high volatility and few return. The risk return level sweet spot, it's much more positive, interesting on the left, and you have in red I think it's CPR fund. Clearly, for the same level of return, you have a very low level of volatility, standard deviation, and so your backtest is to illustrate that and to be able to explain that to your investors.
Exactly. And of course, you can see the SRI of the portfolio. And here you have several information on the performance of this portfolio. And also you can have a view on the analysis of this portfolio, meaning a view on what?
The performance attribution, the return attribution of your fund of fund.
Mm-hmm. So here you have the correlation between all funds available in this portfolio. And here you have a view of the contribution, meaning what is the role of this fund within this portfolio. You can have it on a 1 year basis, 3 year or 5 years. And here you can see that the one that are in the lower left part of this graph are decreasing the performance and decreasing risk.
Okay.
So what we try to do is to say, let's see what this portfolio would have been if we would have suppressed the Clartan Valeur fund. So we created a second portfolio with the top 9 flexible. So it's exactly the same minus Clartan.
Okay.
And here
so you are generating an arbitrage excluding Clartan.
Exactly, and putting all the money equally between all the resting funds.
Mm-hmm.
And as you can see, so here the point corresponding to Clartan is now gone, and we have a 4.95% 3-year performance. And if I compare it to the other one,
you improve your risk return because you eliminated the worst fund.
Exactly.
Okay.
And we made a third let's say scenario in which we said to our customer, okay, so right now you only have flexible. What if we take 10% of your portfolio and buy a commodity fund? So we did that, and we bought which one was it? I think it was Lixor Refinitiv.
Okay.
And as you can see, it has a great influence on the performance because it corresponds to this fund. So it really boosts the performance, and also, as you can guess, it has also the volatility.
You diminish the
964.
volatility and increase because of the correlation between commodities and flexible funds.
Exactly.
It's not because you had a very high volatile fund that you increase the volatility of your portfolio. The volatility of your portfolio is diminishing because commodities help a lot and increase your diversification of your portfolio. Okay, that's cool.
And that's for the last scenario. What we said is, let's try and put some bond in. So we keep all flexible and we put 10% in bond. And well, I will let you maybe have a description of this screen, Jean-François.
Where is the bond fund, Lixor Euro Govies?
It's here.
Yeah, no, but in terms of risk return, it's
it must be, yes, this one.
Okay. So clearly you diminished the return. In terms of volatility, it's very close to CPR, croissance réactive. Could you show us the level of volatility of your portfolio? It was 10% and now 9 point something.
Yes, and it's 893.
A little bit more the level of volatility, but so it's not a big deal. It's not so impressive.
Okay, so as you saw, Quantalys can really help you build several scenarios and explaining to your customer what you are willing to do, or what is your analysis and how to improve the existing portfolio of your client. Everything, of course, is saved in Quantalys and can be found in your client's information when you click on client here.
Okay.
This is going to be the end of our presentation. I'm going to have a quick look.
Thank you very much, Julien.
What?
So I said it's crystal clear, very helpful to have this demo to better understand the capabilities of the tool and Quantalys Global, and to see how it helps to take the right decision.
Exactly. I can see that we have a question for Varenne. Isn't it due to the change of domiciliation of the fund to Luxembourg?
Probably.
Yes, I think it's a very good point that you are stressing right now. So we didn't go through that, but looking at the fund sheet, you could find some more information, and of course you can see the change of domiciliation of the fund, and it's stressed, it's graphically visible.
Yes, no, but clearly we show you the top promoters in terms of asset under management of or net inflows, and sometimes you have these intricacies, new funds created, and you have fund pooling, fund merging, and new fund creating in Luxembourg, and they close the French domicile fund, and so you have this ranking, I would say. But clearly it's the case for a fund like Varenne in that case. Well done.
Okay.
Probably just, do you have other questions?
No, that's about it. We have some thanks from several
lot of thanks.
participants.
6 p.m. Paris time, so we have to leave the floor and to finish this webinar. I hope it helped a lot to better understand the flexible fund universe, and also in that specific context, and also how to use Quantalys tools, Quantalys Global, to take investment decision, and to select fund, and to backtest portfolios, and to help your investors. Thank you, Julien, for your explanation and your presentation. The next webinar or meetings will be in Geneva the 7th of June. It will be a digital, also hybrid event presentation and on-site locally in Geneva. So if you want to register, feel free, don't hesitate on our website, or you contact Julien or me, and it will be a pleasure to see you in June, 7th of June in Geneva, the 15th of June in Luxembourg, and the 28th of June in Luxembourg again, before the summer. And so thank you very much. Take care, and hope to see you soon. Bye-bye.
Thank you. Have a nice day. Bye.